Thanks for inviting me. It's always a pleasure to be back here at the Becker Friedman Institute and on the Chicago campus. I want to make a few remarks about the world economy, and I'm going to try to keep it brief. I'm not going to go through all the slides here because they'll be posted and you can look at them, but I just want to make the two main points that there's data out there from really the middle of 2016 indicating that the world economy is gaining momentum, but the question mark comes from a number of headwinds and risks that we also perceive. So the mean definitely seems higher. The variance is also higher, and that means there's a wide range of possible outcomes. Gaining momentum question mark is, by the way, the title of our new World Economic Outlook. And we actually had quite a fight within the organization about whether to leave the question mark there or not. And our department's position was, you need the question mark. We'll see if we were right. The global economy has been on an upswing since the middle of 2016 after a number of quarters where things actually were looking pretty dicey. What with a lot of volatility in global asset markets, fears about China, and talk about something called secular stagnation. But there's a very broad rebound that we've seen since the middle of 2016. It's been a rebound in manufacturing in particular, and you see it in some data that I will show you. You see it both in market sentiment indicators, so-called soft indicators, but also in hard data, for example, on industrial production. Notwithstanding, there's an ongoing trend of lower productivity growth than, say, a decade ago, pretty much all over the world. And this low productivity growth dampens our expectations for future growth rates. And it probably also affects consumption behavior today, just thinking about a simple permanent income kind of idea. So in advanced economies, for commodity exporters, prospects are very subdued. There are also risks, and I would say more than the usual array of fairly serious possibilities. There are upside risks. We may get tax reform in the US, as the plan indicated last Wednesday, that was issued by the administration. And that could be very supply-side friendly tax reform with big corporate tax cut spurring investment. But there's also risks that we're pretty much near capacity, that investment doesn't expand that much, and that we end up with sharply higher current account deficits, a sharply higher dollar exchange rate. And that's actually the main risk that I'll focus on tonight. But I want to mention some of the others. Tightening financial conditions could follow from that, and that could adversely affect emerging markets. There are geopolitical and electoral risks as well, and these range from conflict in East Asia to electoral outcomes in Europe that might lead countries to exit from the euro, provide further exit than we already have from the European Union. And finally, China is an ongoing concern. China is growing at the moment more quickly than most forecasters would have predicted, but it's doing so on the basis of what one could call fairly unsustainable policy interventions, rapid expansion of domestic credit, continuing support of enterprises in the state-owned system that should probably be shutting down faster than they are, all of which leads to lower productivity growth, lower profitability, and raises the question of how the debts that are being built up will ultimately be repaid. So in the medium term, we also see a risk from China. And it's not only us that say this, the Chinese themselves are saying it. At the fund, we do annual health checkups on our 189 members, and for each one, we have a set of policy prescriptions. But very broadly, we feel that a number of policy approaches would help to preserve the current momentum in the world economy and avoid the downside risks that I mentioned. These could include monetary accommodation continuing where inflation rates are below target, smart growth-friendly fiscal policy, structural reforms in almost all countries, although differing by the nature of the country, which can help make markets more competitive, improve governance, improve the business climate. All of those would be good for potential output and good for growth. One of the advantages of an organization like the International Monetary Fund is it also looks globally and tries to see how the pieces fit together. And when one does that, one realizes there's a large number of collective action problems also in the global economy, where one country pursuing its narrow self-interest may actually harm itself as well as the broader economy, particularly when all countries behave in the same way. International trade and supporting a rule-based trade system is one such area. International financial regulation is another obvious case. But there are other collective action problems with big spillovers across countries, including climate, disease controls, famine, and the resulting refugee problems that are a legitimate cause for the international community to collaborate and work together. So let me just run through a couple of recent data series to just illustrate where we see the world economy and talk basically about where our forecasts are and then discuss one major risk and then wrap it up. The left chart here shows a soft indicator, purchasing manager indices for manufacturing. And if you look at the most recent data, these data go back to the mid-2000s and comprise the collapse in the global financial crisis. It's remarkable, particularly in advanced economies, how big the upswing is. You see a similar upswing in consumer confidence, and if we showed business confidence, you would see that as well. Important to note that these upswings begin in the middle of 2016. There have been movements in asset prices and confidence indicators and other indicators since the US election, but there's really been a broad-based international recovery ongoing since the very difficult first half of 2016. Indicators of world trade, which had been growing very slowly, have been ticking up, and that's something we like to see. Indicators of commodity prices, which in the beginning of 2016 were quite depressed, have also been moving up, particularly for metals and petroleum. And one of the interesting issues to debate over the last few years is whether commodity prices on balance help world growth when they're high or hurt it. That's a very difficult question to answer, but certainly for commodity exporters, some of whom have been in dire straits, this is very good news. And my sense at this point is this actually helps the world economy more than it hurts it. Deflation has been a concern in a number of countries, and deflation risks have receded. So in these charts, warmer colors are higher inflation, and certainly for headline inflation, for PPI inflation, the commodity price upsurge has done a lot to allay the inflation fears. In emerging markets where inflation rates were temporarily high because of depreciating currencies, inflation has come down a little bit. So on the whole, price risks look better in the world economy too. Finally, and this is maybe a question that'll come up in the discussion with Lars, market volatility has been really low. In fact, these charts are a little bit out of date, but the VIX apparently today reached a decades-long low. The sort of conflict between what's going on in these markets and the sort of policy news and policy uncertainty we read about every day in the newspaper has been very puzzling for us in the fund, and I think for a lot of economists. It extends to emerging market yields, which ticked up after the US election and have gotten very low. Many countries that you wouldn't think are great credit risks are borrowing in international markets at extremely low rates. And where we do see the policy uncertainty is on the periphery of Europe, where for a number of countries, spreads over German rates are quite high. France was pretty high until last Sunday. Its premium over the German Bund has come down, but has not gone away. I don't want to spend a lot of time on our specific numerical projections, but in light of these developments, we're pleased that a long-awaited acceleration in growth has finally happened. Since, I think, January 2015, we've been predicting higher growth for the next year persistently every quarter, and it hasn't happened. And now it seems to be happening. So we expect that global growth will tick up from 3.1 to 3.5% in 2017 and to 3.6% in 2018. And a lot of this is driven by emerging markets. Some of them have been growing at negative rates, strongly negative rates. So if they even move to zero, that's helpful for global growth. But also there's been a lot of recent strength in Japan and in Europe. For the US, our forecast for this year is 2.3%. For next year is 2.5%. And that's a considerable uptick from last year's 1.6%, but comparable to what we saw in 2015 in the US, which was 2.6%. And we can discuss this forecast more. It was actually a subject of considerable internal debate, to what extent to incorporate possible new policies of the new administration. In terms of where we came out in these numbers, it might be useful to compare them to where professional forecasters are. These, again, like our forecast, are slightly out of date, but they indicate where the forecasters were when we made our forecast. And you can see that 2.3 for this year, 2.5 for next year is pretty much close to the mode of these forecasts, but the forecasts are really also all over the place. And as you would think, they widen considerably for next year. What this growth rate will be is quite critical for the budget plans that the administration has put out, whether those will be revenue neutral or deficit causing. And it's on the deficit that I want to focus. I also want to make the point that the US now, by all standard measures of either the output gap or full employment, is pretty much there. So if there is fiscal expansion, it will be happening at a time when standard measures of full employment indicate that that state has been achieved. These are our forecasts for emerging markets. Again, I don't want to spend a huge amount of time on these, but just to indicate that China is considerably revised up. But this doesn't indicate necessarily a vote of confidence, because we are worried about the longer term in China. Let me sort of wind up, because I don't want to really take away from the Q&A and the other discussion, by talking about one downside risk, which is the risk of dollar appreciation. As I indicated, the US is pretty close to full employment at this point. It may be that some of the decline in labor force participation could be reversed by a more expansionary fiscal policy. It could be that fiscal policy expands productive capacity through physical capital or in other ways. But that's a big question mark. If we do end up with a deficit increasing fiscal policy, that could put us pretty much in a similar situation to where we were in the early 80s or the early 2000s, with expansionary fiscal policy colliding with a full employment economy, generating inflation, generating increases in long-term interest rates, causing the Fed to react more strongly than it would have otherwise, and leading to a very rapid dollar appreciation. Now, one consequence of such appreciation that we've seen in the past is crises in emerging markets. And this chart indicates the correlation between strong dollar and those crises. It's not perfect, but it is pretty convincing to those who have studied these episodes. And the mechanisms are basically two. That number one, with higher US interest rates, indebted emerging markets find it harder to service their debts. And to the extent that those debts are denominated in dollars, there could be adverse balance sheet effects because the strengthening dollar increases the value of those debts in domestic currency, makes it harder for firms to pay. You get a credit collapse, you get recession. Depreciating currencies also put more pressure on inflation. And you might have economies which are actually struggling still from the period of low commodity prices, but where the central bank is forced to push up domestic interest rates to contain inflation, contrary to where the domestic business cycle is. So there are all sorts of risks for these economies. We certainly saw this in the early 80s when the US policy mix triggered a huge debt crisis in developing countries that had borrowed over the course of the 1970s. The other risk is a risk for the US and for the global trading system. Inevitably, if there's a large deficit-financed fiscal expansion in the US leading to a stronger dollar, the current account deficit of the US will increase. Now, it's the stated policy of the US administration to reduce the trade deficit. And they've been approaching this by going around bilaterally to our trading partners and looking for unfair trading practices upon which the US can pressure them. There's a famous mathematician named Stanislaw Ulam who once challenged Paul Samuelson to name just one proposition in economics that was not totally obvious. And Samuelson thought for a moment, and then he answered comparative advantage. I think there's a second proposition that's not totally obvious, and that's the identity that the current account equals saving minus investment. A huge increase in US dissaving, which is not, especially if there's a surge in investment, will lead to a bigger deficit. It just has to be. Going around country by country doesn't change saving or investment. So there's got to be a collision here somewhere if this is the policy path for the United States. In earlier episodes, for example, the late 80s, we saw a lot of trade actions. We saw the 1988 trade bill, which is the one in which the system of annual treasury reports on currency practices originates. And the response might well be the same here in that case. One of the big risks that I didn't highlight as much as I probably should have at the beginning is the risk of protectionism in the world economy. And the US policy mix could push us in that direction. Again, there are other threats out there, but this is certainly one of the big threats creating variance in our forecast. So I'll stop there.
I'm curious how you use economic models in shaping your perspectives on various policy challenges facing the IMF. going a bit further, to what extent do you use models to make quantitative assessments, or is there more use of, or are they more qualitative in nature? For instance, you gave us a bunch of forecasts here. Were they kind of reduced form time series models, or how much structure is imposed on them, and kind of how are you using economics to both make forecasts and frame your thinking?
So you're asking me how we make the sausage, right?
Something like that.
Sausage making is never pretty. Hopefully it's tasty, but it's a very complicated process. So we have a team in our research department called economic modeling, and they do the modeling. They generate. That's not where the forecasts come from, though. But they do track both high frequency and lower frequency data very carefully. They have tracking estimates of GDP for a number of major countries, not for all 189 members, but for the major economies. And they also look at various scenarios to sort of get a fan chart of where the risks are. So, if you look at the kind of risks I talked about, and if you think one of the risks is that the US puts 20% tariffs on China, which I guess is not going to happen now, but you can model that, and that gives you one downside risk. The numbers we actually report are modal estimates, so they're not expected values, but we actually, like most professional forecasters, we give a most likely scenario, and then other scenarios, we don't report the probability of the most likely scenario, but we have some sense in our minds of what it is. But you can imagine trying to talk to the press about, why do you think the probability of that outcome is 0.2, and how did you get that? And so a lot of it is just, frankly judgmental. So these numbers are, we use these as inputs into our conversations with the desks, and each desk is assigned to a country and does the surveillance of that country and is in touch with the central bank and finance ministry of that country. And they know the country's views on output, and they've seen the country's models. And so we engage in back and forth with those desks, sort of confronting what they have with what we have, until we converge on a number that we think is, that we can jointly agree is reasonable. Now the problem is that once you've done this for 189 countries, you need global consistency. Like if the world is running a huge current account, well, it actually is running a huge current account deficit with some unnamed planet, but if that discrepancy is too big in the forecast, something is wrong. So then we go back to the countries, look at what's wrong, try to reach something that is consistent, and that is our forecast. So modeling is a component, but judgment is also a component. We also have an exercise called the External Sector Report, which tries to judge where current accounts should be and where exchange rates should be. And there too we follow a very similar process of modeling combined with interaction with the country teams. And consistency checks, because it can't be that everyone is running too big of a deficit. It can't be that everyone's overvalued. So it's that mutual consistency that really differentiates what we do from what most forecasters do. It's a truly global product.
Okay. I hope there's not going to be a quiz about how all that works exactly. But anyway. Sounds. So your talk, you mentioned quite a bit about the potential quantitative impacts of uncertainty, and this leads me to wonder how you think about obtaining the quantitative inputs into those type of calculations. So we could imagine things like news reports, and they seem often slanted towards uncertainty that might be resolved in the near future, or uncertainty as it initially emerges, say Brexit or the U.S. presidential election. Forward-looking financial markets proved to be another barometer, but seemingly imperfect one. And I think about a lot of the challenges we face, both in terms of secular stagnation or the fiscal challenges, they could play out over very long time horizons. And uncertainty as to how these challenges might be ultimately resolved may remain unclear for quite some time. So do you have other ways you think about or monitor this uncertainty, or what's the...
I mean, that's one of the hardest questions for us, obviously, and we look at a number of measures. One is just the dispersion in terms of professional forecasts, such as I illustrated. We look at the market indicators, and as I said, those have been really low lately, so we don't know what to make of that. We look at policy indicators. I mean, the leading one is the Baker-Bloom-Davis, Steve is here, index, and we make a lot of use of that. Though, again, sometimes it's hard to gauge. If you look across countries now, you see some countries where policy uncertainty is greater than at the height of the global financial crisis. It's hard to sometimes interpret that index. Our new director of money and capital markets, Tobias Adrian, would like to. So money and capital markets basically looks at financial stability, and they publish the Global Financial Stability Report. It's an excellent publication, recommended highly. But they look for financial market risks in banking and capital markets. And what he would like to do is actually use models that forecast conditional densities going into the future to try to get a handle on exactly your question. And that's kind of work in progress. I think it's very promising, but the difficulty is when you have these all require some sort of stationarity, as far as I know. And so if you have a big regime change and all the rules are different, what do you do? For example, you're trying to do your forecast for the British economy, and then suddenly they vote for Brexit. Yeah. Or you have the outcome of the US election with a very different policy platform from what has been the consensus approach for both parties. So those sorts of uncertainties, they sort of get you into the realm of the unknown unknowns, and we don't know what to do with those, really.
So there's lots of speculation about this uncertainty being really important, having real consequences to say the world economy. What's the good hard evidence on this, or is this largely speculation, or?
We have a lot of theory. There isn't a lot of hard evidence, I have to say, and it's partly because of how hard it is to model uncertainty. Now, some folks at the World Bank did a recent study where they basically model global trade, the volume of global trade as a function of a number of trade factors plus the Baker-Bloom-Davis measure, and they find that that's incredibly important in explaining the slowdown in world trade. We've done work on trade, and we find that the fall in the level of investment is the prime driver, because investment is very trade intensive. Now, it could be that the uncertainty has caused investment to fall, and that's what caused trade to fall. So I think it's it's still very much a question of debate, and it sometimes gets us in trouble. For example, in the Brexit run-up, we, along with all other forecasters, thought that the uncertainty over the terms of Brexit would lead a lot of companies to hold up investment plans to see how the rules would shake out, and sort of a option value of waiting kind of argument. And we thought that would hurt on the investment side. And while there's been a little bit of that, consumption in the UK has been unbelievably strong. Now, why that should be, we have no idea. The first quarter of this year in the UK was really weak, but that seems to be due to temporary factors. So we're still waiting for these uncertainty effects to hit, but it's hard to identify them, econometrically in a way that is convincing. So we believe this is an issue, but the hard evidence is not that easy to come by.
So we have some students in attendance here, and I know that the IMF recruits interns with a background and interest in economics and policy. Could you comment briefly on kind of why experience with research conducted at the IMF can help nurture young scholars and what backgrounds you might be looking for in recruiting interns?
Well, there are a number of internship opportunities that fulfill, a similar role, and I would mention like, Council of Economic Advisors, the Federal Reserve Board, and Federal Reserve banks. Anywhere where you can work with, economists who are addressing real policy questions with real data, and applying state-of-the-art tools. It really gets you out of the graduate student frame of mind of, just focusing on the literature and sort of focusing on the question and the policy. The best description of this process that I've heard comes from Jan Eberly, who's professor at Northwestern and was Assistant Secretary of the Treasury for Economic Policy in the Obama administration. And she said that the great thing about her job is it's a chance to practice her craft. I think economists do learn a craft, a way of analyzing the world, a way of looking at the world, which sometimes it helps if you're pulled out of the ivory tower and forced to just answer a very applied question, which might not be the thing you work on in your thesis, but from which you nonetheless learn a lot, and which actually helps policies be better.
Okay. I think what I'd like to do now is to open the questions up to the audience. We have some mics available that people can bring them by. And
Thanks for the speech and the conversation so far. I wanted to follow up on Lars's question, one of his questions, and part of your response about trade policy uncertainty in particular. So there's been at least two major events that you think would have a profound effect on trade. You mentioned them. There's the Brexit election. There's the Trump surprise victory in the U.S. election, given his stance on trade. And I, like you and many others, have asked, well, where do we see the evidence on investment? And you'd think that at least in those two episodes, the evidence would show up most intensively with respect to trade-creating type investments. Mm-hmm. And then you start to think, well, where do you look for those those kinds of investment activities? It's not clear we have a great handle on exactly what type of investments feed into trade and which in a particularly intensive way. I wanted to get your take on how the IMF tries to deal with that, what I think of as a data challenge to some extent, with respect to those two episodes in particular. Or do we have some high-quality data that would allow us to say this is investment that's really focused on trade-creating activities, the creation of distribution networks, the creation of products for foreign markets, and so on. So maybe that's not a sharp enough question, but I think you get the drift.
Yeah. The fund we've for us sort of working with microdata is a fairly recent phenomenon, and I think people have realized that you can just get so far with the macro data, and as you say, in this, for example, this trade question, you really need to look at firms and firm characteristics, and basically look at difference in difference type of methodologies to see these effects. Where we've been looking, what we've been trying to do is sort of focus on global supply chains and try to tease those apart some. And the motivation has been not so much effects of uncertainty, although you could look there, but just the effects of protection. It used to be sort of the view of some people, including some distinguished trade economists, that the welfare losses from restricting trade were not really a big deal because it's a Harburger triangle, so why is that a big deal? And then there are all kinds of stories you can tell about dynamic gains from trade. But it turns out if you look at integrated supply chains and what happens when you disrupt them, the gains from trade can be, the losses from that can be huge. So Arnaud Costineau at MIT and my colleague from Berkeley, Andres Rodriguez-Clare, have a chapter in the Handbook of International Economics, the last edition, where they can calibrate models to look at these losses, and they can be really, really huge, significant percentages of GDP. So I think this is where we should be looking, and it may be that if we can look at investments in these particular industries that are tightly integrated with across the border, say with Mexican industry, with Canadian industry, or within the East Asian supply chain, we can actually see these effects. Now, part of the problem here is that just the amount of time series data available. I mean, maybe you can do cross-sectional studies, but this is a fairly recent thing, and I think the environment is still fairly unsettled. I do think that if you were a firm now thinking of expanding your investment in the Mexican supply chain, you would be really, really worried about doing that. And both because the administration has injected a lot of uncertainty about the future of NAFTA, and the the shift in the political attitude in Mexico toward the U.S. that has resulted from all this makes it more likely that you get a Mexican president who's pretty market unfriendly in the next election. So, again, we don't have the hard evidence. It would be great if we could establish that, because that would help us as economists make the arguments that injecting this kind of policy uncertainty really does do damage.
Hi. So, you talked about uncertainty, as well as, the 2016 election and, unknown unknowns. Those things you can't see, but there's some things that the IMF has made itself, like the crisis in Greece. So how do you think that, IMF addresses these crises to avoid uncertainty itself? And because, I was reading that the IMF still hasn't come up with a concrete solution to address the Greek crisis. So, how do you think IMF can, design policies to, decrease uncertainty and to, increase policy making?
Well, Greece is a great example. It's actually a fantastic example, and one doesn't really know where to start when talking about Greece. But it also relates to something I meant to bring up in response to Lars's question, which I didn't because I forgot. But Greece is right now in its third support program, and it's one in which the IMF is not participating as a lender. We participate in providing advice to the Greek government, and we negotiate together with the other European countries, with the Greek government on the types of reforms that they might put in place to support growth and also to improve the business climate, decrease uncertainty. But one of the biggest causes of uncertainty in Greece is the huge level of debt for the economy, which creates several kinds of debt overhangs. But one of them is simply that, because it's quite uncertain how this debt will ever be repaid, it makes policies very uncertain. It deters investment. And it requires the Greek government to take pretty harsh measures to maintain the budget surpluses that can service that debt. And those harsh measures create social and political strains, which also make policy very uncertain. You never know when there'll be a policy reversal. So, it would be a mistake to think that, even though we've been involved with Greece, that it's simply about Greece and the IMF. It's actually a three-way negotiation with us, the European institutions, and Greece. And the European institutions and the European countries don't always agree among themselves, which makes it harder. So all of that injects a lot of uncertainty into the process. Our view, and what we've been trying very hard to get the Europeans to agree to, is a reduction in the outstanding debt of Greece, which is mostly being officially held. There was a debt restructuring in 2012, which sort of hit the private sector. We'd like the Europeans to lengthen drastically the maturities of what they are holding. And here when I say drastically, I mean, like over the next 100 years. I mean, we're really talking a big reduction in present value. And if they do that, they will be able to service that debt with smaller fiscal surpluses, which will make it socially more sustainable. Now, the Europeans essentially don't agree with us. They feel that a larger surplus is sustainable. They feel the debt problem isn't that bad. But our view is really that the uncertainty and the burden are critical to reduce. Now, why do we take that position? This is where the long-term uncertainty comes in. In cases like Greece, we carry out what we call a debt sustainability analysis, which looks at the country's ability to service the debt over the long term. And here, of course, there are many, many uncertainties. We've kind of insisted with the Europeans that they use our debt sustainability analysis. They have their own, which is much more favorable. And this is where the tension is. So, at the end of this month, there will be a meeting where either we may decide we can come into a Greek program, but that will require Europeans to write down the debts they're holding considerably to reduce some of these uncertainties, or we may walk away. Probably not walk away, but go to the next negotiation. We're not going to walk away from Greece in terms of technical assistance or capacity development, but whether we actually participate in a program, our rules don't allow us to do that unless we can state that the debt is sustainable with sustainable, politically, socially sustainable policies with a high probability. And right now, unless there is a big debt reduction, we can't say that. So, we're certainly trying to reduce uncertainty for the Greek economy, facilitate a policy package that they will actually carry out without social unrest and without undue suffering.
Following the 2008 crisis, a lot of people will argue that the lower and middle classes did not share in the recovery, which might explain a lot of the political uncertainty we are seeing right now. First, will you agree that they did not share that much in the recovery, that lower and middle classes? Will you agree with that assessment? And the second part of this will be that in the next 2 years, the growth you're talking about, do you think that growth will, to use the terms, trickle down more, which might in turn actually reduce that political uncertainty we are seeing? Thanks.
Well, I would resist your implicit assumption that all of this is about what happened since the global financial crisis. These trends have been in place for a really long time. They have been, obscured by somewhat higher levels of growth, but there hasn't been a lot of growth to spread around, since 2008. And so I think the tensions have grown, and the expectations that policy would be able to do more than it did have boiled over into frustrations, and we saw the outcome in the election. Even if growth accelerates, and my personal feeling is, given the policies we've seen, there's no reason to expect a very high rate of growth beyond the current potential, which is for the U.S. below 2%. There's no reason to expect more trickle down than we've seen without different decisions about the tax system, different investments in education, investments in lifelong learning, reskilling, and policies that generally aid workers to adjust to not only trade shocks, but also to technology shocks, which we think are going to be coming aplenty in the coming years. So I think there's a big agenda there. What's interesting, though, is that if you look at emerging markets, we talk about the backlash against trade. This is really a phenomenon of advanced economies, and not Japan. It's the U.S. and Europe. And when we talk about this with emerging market interlocutors, they say, "What are you talking about? We think trade is great. Trade has brought millions of people out of poverty. Trade has helped us grow. If the trading system falls apart, we're really in trouble because we depend on it." And this is one of the slides I didn't show you, but just looking at poorer countries that have grown, even the lower percentiles of the population have seen their incomes rise a lot. And so the attitudes toward trade are really, really positive in these poorer countries that have grown. The advanced countries haven't seen that growth in the aggregate. Again, what growth there has been has not been well distributed. And so there's, perhaps understandingly, a cynicism toward trade and a willingness to follow leaders who blame trade for, all ills. But these ills are certainly rooted more in technology than in trade. Well, of course, we thrive on uncertainty because it gives us a lot to talk about. There was a time, not that long ago, when we talked about the Great Moderation, and we never should have done that because it brought on the global crisis, certainly. But uncertainty seems to breed more uncertainty in the absence of really effective policies to cope with it. And one of the things that has really struck me since coming to the fund is that we publish our World Economic Outlook twice a year. And at those times, we have our spring meetings and our annual meetings, and we also do our World Economic Outlook projections. And that was the pattern up until 2008. And in 2008, my predecessor, Olivier Blanchard, and the management of the fund decided that things were moving so quickly that we needed to do quarterly updates. So we only do the World Economic Outlook twice a year, but in July and January, we update the data and give a renewed forecast. Which in this year was very important after the Trump election. In July, it was very important after Brexit. Management keeps saying that the idea of the 4 quarterly forecasts was to be temporary and to go away after the crisis. And why can't we, go back to just doing it twice a year? And every time they say that, something like Brexit happens, and it's obvious we can't. So, if we can ever go back to twice a year, that will be a really good sign for the world economy that some of this uncertainty has gone away. But in the interim, we feel stuck because things change quickly, and there's a tremendous interest in our updates simply because there are new uncertainties that come along. I don't see things calming anytime soon for Europe and the U.S. On the other hand, if you look at Asia, I just came from Indonesia. Compare Indonesia to 20 years ago, and there's a lot more policy certainty. There's a lot more sense that policy is moving in the right direction, that they've improved their policy frameworks, that things are more predictable. So, it's not everywhere in the world where there is this uncertainty, but of course those countries, when you talk to them, they say, what's Trump going to do? And the answer is we don't know. So they're getting it, from the external side. We're generating it.
We have time for one more question.
You've mentioned the use of soft data versus the hard data. And I know that the industry calls it nowcasting, and it's also being done at the Fed. I was just wondering if you thought that was like kind of an ongoing long-term trend, or if it was a response to the growing uncertainty or the availability of data.
I think it's a response to data availability and computational power that allows you to do these things. That you can always if you can forecast better than the next guy, you can always make a buck. So that demand is always going to be there. But it's certainly the interest in the general consumption of these things has been increased greatly by the the uncertainty, the crisis conditions, and the interest that's generated in the broader public.
Okay, well, with that, I would like to thank Maurice one last time for a great conversation and talk.
Thank you.
Thank you.
Thanks very much.